Stablecoins are pivotal in the digital currency revolution, offering price stability in volatile markets. This presentation will explore their historical development, types, market dynamics, regulatory landscape, technological infrastructure, economic impact, risks, and future prospects. Stablecoins serve as a bridge between traditional finance and digital assets designed to maintain a stable value relative to a reference asset. They address the extreme volatility of Bitcoin and other cryptocurrencies, making them impractical for everyday transactions. Stability is achieved through fiat currency reserves, algorithmic supply adjustments, collateralization with other cryptocurrencies, and hybrid models. Stablecoins serve as a bridge between traditional finance and digital assets, maintaining stable value relative to a reference asset. They address the volatility of cryptocurrencies like Bitcoin, making them practical for transactions and value storage. Stability is achieved through fiat currency reserves, algorithmic supply adjustments, cryptocurrency collateralization, or hybrid models, highlighting their significance in the financial ecosystem. The first stablecoins appeared in the early 2010s, facing technical and regulatory hurdles. BitUSD, launched in 2014 on the BitShares platform, used cryptocurrency collateral for stability. Tether, introduced the same year as Realcoin, was backed by United States dollar reserves. United States dollar coin emerged with a focus on regulatory compliance, coinciding with the decentralized finance boom and shifting regulations. Fiat collateralized stablecoins are backed by fiat currency reserves, such as United States dollars held in bank accounts. Examples include Tether, United States dollar coin, Binance, United States dollar, and True United States dollar. Trust in the issuing entity and banking infrastructure is crucial. Cryptocurrency collateralized stablecoins like MakerDAO's DAI use cryptocurrencies as collateral, requiring over-collateralization and smart contract management. Algorithmic and hybrid stablecoins offer alternative mechanisms. Fiat collateralized stablecoins are backed by fiat currency reserves, often United States dollars held in bank accounts or money market funds. Examples include Tether, United States dollar coin, Binance United States dollar, and True United States dollar. Users deposit fiat currency and issuers mint equivalent stablecoins. These tokens are burned upon redemption. This model offers price stability but demands trust in the issuer and banking infrastructure. Cryptocurrency collateralized stablecoins use digital assets like Ethereum and Bitcoin as collateral. MakerDAO's DAI exemplifies this, requiring over-collateralization due to volatility, such as $150 in Ethereum for $100 in DAI. Smart contracts manage collateral ratios, triggering automatic liquidation if values drop. This approach offers decentralization but faces challenges in maintaining stability. Algorithmic stablecoins adjust supply based on demand, using mechanisms like rebasing and dual token systems. Terra USD maintained its peg through minting and burning with Luna, but collapsed under market stress. Ampleforth employs rebasing to adjust balances. These systems face challenges, particularly during volatile market conditions, highlighting the need for robust mechanisms. Hybrid stablecoins like Frex Protocol blend collateral backing with algorithmic mechanisms, dynamically adjusting collateral ratios based on market conditions. During stress, collateral increases. During stability, it decreases. Multi-collateral systems accept diverse assets, including fiat and cryptocurrencies, enhancing stability and resilience by diversifying risks across various asset types and mechanisms. The stablecoin market has seen explosive growth, with market capitalization soaring from under $20 billion in 2020 to over $120 billion in 2022. Tether, United States dollar Tether, leads, holding 60 to 80% of the market thanks to its first mover advantage and broad exchange support. United States dollar coin, emerges as a primary challenger, while institutional adoption and decentralized finance ecosystems drive demand. The Genius Act, enacted on July 18, 2025, establishes a comprehensive regulatory framework for payment stablecoins in the United States, categorizing issuers and ensuring full reserve backing. In Hong Kong, the Stablecoins Bill mandates licensing and over-collateralization for fiat-referenced stablecoins with penalties for non-compliance. Globally, regulatory convergence emphasizes reserve requirements and anti-money laundering or know your customer compliance. The Genius Act, signed into law on July 18, 2025, establishes a comprehensive regulatory framework for payment stablecoins. It received bipartisan support, passing the Senate Banking Committee 18-6, the full Senate 68-30, and the House 308-122. Permitted issuers include subsidiaries of insured depository institutions and federally qualified non-bank issuers regulated by the Office of the Comptroller of the Currency. Hong Kong's Stablecoins Bill, passed on May 21st, 2025, mandates licenses for issuing stablecoins locally or Hong Kong dollar-backed globally. Effective August 1st, 2025, it imposes penalties up to Hong Kong dollar 5 million and 7 years imprisonment. Requirements include Hong Kong dollar 25 million minimum capital, full backing by liquid assets, and guaranteed redemption at par value. Major participants engage in a regulatory sandbox. Before 2025, regulatory fragmentation was evident. In the United States, multiple agencies like the Treasury, Federal Reserve, and SEC had overlapping jurisdictions. States like New York and Texas had unique frameworks. The European Union introduced MyCA, addressing stablecoin issuers, while the European Central Bank raised concerns. Asian jurisdictions also had varied approaches, highlighting global regulatory diversity. Global regulatory convergence focuses on reserve requirements, ensuring full backing by high-quality liquid assets. Redemption rights guarantee conversion to fiat currency at par value. Operational standards include minimum capital requirements, segregated reserves, and robust governance. Anti-money laundering, know your customer compliance mandates, comprehensive anti-money laundering measures, and customer identification. Regulatory supervision is essential for maintaining these standards. The United States Genius Act serves as a potential model for stablecoin regulation globally, while Hong Kong's framework aims to establish the city as a digital asset hub. However, regulatory fragmentation, such as the European Union's MiCA framework, poses compliance challenges. Coordination between regulators is essential for developing compatible frameworks with a focus on reserve management and anti-money laundering, know your customer requirements. Blockchain networks for stablecoins vary in transaction speed, cost, security, and programmability. Ethereum dominates with its mature ecosystem and smart contract capabilities, hosting major stablecoins like USD Coin, Tether, and DAI. Alternatives like Polygon, Arbitrum, and Optimism provide faster, cheaper transactions. Cross-chain interoperability and technical implementation are crucial for privacy and compliance. Ethereum stands as the leading platform for stablecoins, hosting the majority of supply and handling significant transaction volume. Its mature ecosystem offers extensive developer tooling and advanced smart contract capabilities. Major stablecoins like USD Coin, USDC, Tether, USDT, and DAI thrive on Ethereum, benefiting from its liquidity and decentralized finance (DeFi) integration. Ethereum's scalability issues, such as high transaction fees, have driven stablecoin deployment to other platforms. Layer 2 solutions like Polygon, Arbitrum, and Optimism offer faster, cheaper transactions while maintaining Ethereum compatibility. Binance Smart Chain provides low fees and fast confirmations, though decentralization concerns persist. Solana offers high performance, attracting stablecoin projects seeking efficiency. Cross-chain interoperability is crucial as stablecoins expand across multiple blockchains. Bridge protocols facilitate stablecoin movement but can introduce security vulnerabilities. Native multi-chain stablecoins managed by issuers across networks offer enhanced security but demand complex operational infrastructure. Understanding these dynamics is essential for navigating the evolving blockchain landscape. Fiat-backed stablecoins utilize simple smart contracts for minting, burning, and transfers with administrative controls for compliance. Decentralized stablecoins like DAI employ complex systems for collateral and governance, managing extreme market conditions. Algorithmic stablecoins, the most complex, use price oracles and supply adjustments, but face potential security vulnerabilities during market stress. Privacy and compliance in stablecoins involve technical challenges due to regulatory demands. Transaction monitoring and user identification are essential, balancing blockchain's pseudonymous nature with compliance. Some stablecoins embed compliance features in smart contracts, while others rely on off-chain monitoring and intervention to ensure adherence to regulations. Stablecoins play a crucial role in decentralized exchanges, providing liquidity and facilitating trading. Automated market makers like Uniswap and Curve rely on stablecoin pairs for efficient price discovery. Yield farming offers economic incentives, though yields can be unsustainable. In emerging markets, stablecoins help preserve purchasing power. Notably, Tether and Circle are significant holders of United States treasuries, impacting the market. Traditional remittance services charge 5 to 10% fees and take days to settle, especially costly for developing country corridors. Stablecoins offer near instantaneous transfers at a fraction of the cost, though users must navigate cryptocurrency exchanges. Migrants send stablecoins to families in emerging markets, who then convert them to local currency, highlighting both advantages and challenges. Stablecoins significantly influence United States debt markets, with Tether and Circle holding $98 billion and $22 billion in United States treasuries, respectively. This positions them as the 18th largest United States debt holders. With 80% of the $250 billion stablecoin market invested in treasuries, they are crucial as traditional foreign buyers reduce their holdings, impacting fiscal strategies and regulatory frameworks. Stablecoin demand may generate up to $2 trillion in treasury demand, with projections suggesting the market could reach $2 trillion by 2028. This positions stablecoin issuers as potentially the second largest United States debt buyers. They bolster United States dollar dominance, sustaining demand for dollar-denominated assets and reinforcing the dollar's role in global trade and finance. The concentration of treasury holdings within crypto-native firms poses systemic risks. A stablecoin run could trigger mass treasury liquidations, destabilizing the market. Stablecoin growth may reduce the Federal Reserve's influence on interest rates and shift deposits from banks to stablecoin issuers, weakening banks' funding sources. Operational risks, including duration risk, further complicate the landscape. Stablecoin liquidity pools in decentralized exchanges facilitate trading and enable market making and arbitrage. Yield farming and liquidity mining create economic incentives, offering high, though often unsustainable yields. Stablecoins serve as a base currency in decentralized finance, providing stable units for financial activities and facilitating billions in lending and borrowing without traditional banking infrastructure. In countries like Argentina, Turkey, Lebanon, and Nigeria, stablecoins are crucial for preserving purchasing power amidst currency instability. They provide access to dollar-denominated assets without traditional banking, offering financial services to underbanked populations. However, governments face challenges in maintaining monetary sovereignty and enforcing capital controls, often responding with restrictions on cryptocurrency trading. E-commerce and digital payments are evolving, reducing processing costs and enabling innovative business models. Stablecoins are increasingly accepted by online merchants and integrated by payment processors, offering programmable features like streaming payments and automated micropayments. These advancements open new opportunities in digital content monetization and subscription services, enhancing the digital economy's efficiency and reach. Counterparty risk in stablecoins requires trust in issuers' reserve management, with transparency and oversight varying. Reserve composition impacts risk. Cash or short-term securities offer low credit risk, while commercial paper or longer-term securities provide higher yields but increase risk. Operational, regulatory, liquidity, algorithmic, and systemic risks, along with treasury market concentration, pose additional challenges. Counterparty risk in stablecoins requires users to trust issuers' reserve management, which varies in transparency and oversight. Reserve composition impacts risk. Cash or short-term securities are low risk, while commercial paper or longer-term securities offer higher yields but increase risk. The 2008 financial crisis showed that even safe money market investments can face liquidity pressures and losses. Operational risks in stablecoins include cybersecurity threats, key management failures, and smart contract vulnerabilities. Regulatory risks arise from evolving government oversight, potential prohibitions, and fragmented regulations. Regulatory proposals like Federal Deposit Insurance Corporation insurance requirements could significantly alter operations. These factors highlight the need for robust risk management strategies in the stablecoin ecosystem. Liquidity risks emerge during market stress, often triggered by excessive redemption demands. Liquidating reserve assets quickly becomes challenging, especially if their value declines, straining systems. The interconnected nature of stablecoin usage across decentralized finance protocols heightens systemic risks, where stability issues in major stablecoins can lead to cascading effects throughout the financial ecosystem. Algorithmic stablecoins like Terra USD rely on complex incentive systems. Their experimental designs can lead to catastrophic failures, as seen with Terra USD's collapse, causing death spirals and massive losses. During extreme market conditions, normal arbitrage mechanisms may fail, eroding market confidence and potentially triggering self-fulfilling instability. Stablecoin growth poses systemic risks, challenging long-term stability and impacting United States Treasury markets. Their integration reduces the Federal Reserve's influence on interest rates, creating independent effects on Treasury yields. This shift weakens traditional banks by moving deposits to stablecoin issuers, potentially reducing credit availability. Concentration of reserves among few issuers heightens liquidity risks during market stress. Central bank digital currencies, CBDCs, are poised to disrupt private stablecoins as major central banks explore digital currencies. A complementary approach is emerging, with institutional infrastructure advancing through custody, trading, and settlement capabilities. Regulatory sandboxes accelerate adoption, while enhanced stability mechanisms like full reserve backing and programmable money features promise global financial inclusion. Central bank digital currencies, CBDCs, are emerging as potential disruptors, with major central banks exploring digital versions of their currencies. The Federal Reserve's digital dollar, European Central Bank's digital euro, and China's digital yuan could compete with stablecoins. Regulatory frameworks like the United States Genius Act suggest a complementary coexistence, while Hong Kong positions regulated stablecoins as legitimate financial infrastructure. Traditional financial institutions are enhancing custody, trading, and settlement capabilities to align with United States and Hong Kong regulations. Major banks like Standard Chartered are engaging in regulatory sandboxes and preparing license applications. This regulatory clarity fosters legal certainty, enabling new business models and partnerships, potentially driving mainstream adoption of digital financial assets. Enhanced stability mechanisms for stablecoins involve full reserve backing in the United States and Hong Kong, prohibiting algorithmic stablecoins. Innovation is encouraged through reserve management and yield generation within regulatory limits. Stablecoins are backed by tokenized real-world assets like real estate and corporate bonds, though strict reserve requirements may limit innovation. Programmable money, powered by smart contracts, enhances stablecoin functionality. It enables conditional transfers and streaming payments, moving beyond simple transactions. This infrastructure supports automated investment strategies and complex financial instruments, fostering new economic models and innovative business processes. Stablecoins hold promise for financial inclusion by offering services to underbanked populations, leveraging smartphone adoption and blockchain infrastructure. Challenges include user education, technical accessibility, regulatory compliance, and local economic integration. Success requires collaboration between stablecoin developers, local partners, and regulatory authorities to ensure effective implementation and adoption. Stablecoins are pivotal in bridging traditional finance with blockchain, addressing cryptocurrency volatility. Regulatory developments like the United States Genius Act and Hong Kong's Ordinance transform them into regulated instruments, fostering institutional adoption. Comprehensive licensing, full reserve backing, and robust governance ensure stability. Diverse approaches and economic impacts highlight their potential, despite challenges and risks. In 2025, stablecoins evolved significantly with the United States Genius Act and Hong Kong's Stablecoins Ordinance, transforming them into regulated financial instruments. These regulations establish clear legal frameworks and licensing regimes, facilitating institutional adoption. This shift addressed the volatility of cryptocurrencies, bridging traditional finance with blockchain systems and setting the stage for diverse stablecoin approaches. Stablecoins exhibit diverse approaches, including fiat-backed, algorithmic, and hybrid models. Regulatory constraints particularly affect algorithmic stablecoins. Innovations are emerging in reserve management, cross-chain interoperability, and programmable payment features, enhancing their functionality and adaptability in the evolving financial landscape. Regulated stablecoins are expanding beyond cryptocurrency trading and decentralized finance, impacting various financial sectors. Clear legal frameworks enable new applications in corporate treasury management, facilitate cross-border payments, and enhance digital commerce. They also provide infrastructure for traditional financial services, transforming payment systems and improving monetary transmission mechanisms. Major issuers dominate the market, creating systemic risks requiring regulatory oversight. Innovative stablecoin mechanisms introduce technical risks, exemplified by the Terra USD collapse, necessitating continuous vigilance. International coordination is crucial to manage cross-border operations and prevent compliance conflicts across varying regulatory frameworks. The 2025 regulatory frameworks aim to balance oversight with innovation, ensuring compliance while fostering development. Approval processes for new licenses highlight the framework's welcoming nature, impacting both traditional financial institutions and financial technology companies. Regulated stablecoins play a crucial role in payments and finance, underscoring the significance of these developments and the need for collaboration to realize their potential. Stablecoins are entering a new era, marked by regulatory clarity and institutional adoption. The 2025 frameworks provide a foundation for their evolution, balancing digital asset efficiency with stability. Their impact on the global financial system hinges on effective regulation, ensuring innovation while safeguarding consumers.